Many Americans clench their teeth in frustration whenever the 2008 housing market meltdown is brought up in conversation. Few things in the last several decades have struck fear into the hearts of homeowners like the infamous housing bubble bust that year. A combination of sloppy lending practices and excess supply on the market as a result of the fallout from subprime mortgages led to a sharp decline in demand. A financial black hole was therefore created. The value of homes for thousands of people fell. The economic slump that followed the historic market crash was the worst the United States has seen since the Great Depression of the 1930s. Recently, several economists have raised red flags by making comparisons between the present cooling trend in the U.S. housing market and the circumstances before the 2008 collapse. In the middle of a boom in building new homes, which will soon flood the market, housing demand is dropping quickly. So is the current U.S. housing crash compared with the 2008 crash? Is it worse than 2008, or will it recover sooner than that? Stay with us till the end to find out. Falling demand has hit even the hottest real estate markets. Some of these cities include Seattle, Phoenix, Boston, San Francisco, Denver, and Dallas. In fact, current U.S. house price declines are the biggest since the market crisis of 2008. There is widespread concern about the possibility of a recession. Even if 2023 will be different, the home market might yet face difficulties. Economic models will tell you that home prices in formerly hot housing markets are as much as 75% higher than they should be given slowing wages and rising interest rates. If you know how to read between the lines, you can figure out what the Feds want or need and what is going to happen. A few years following the pandemic, the property market was very hot due to rising demand and historically low interest rates. The imbalance between supply and demand in the market has to be corrected. Anybody in the market for a home, as well as those considering investing in the real estate market, should take note of the potential consequences of the current downturn in housing prices. In spite of the fact that the iShares House Building ETF ITB is already down by more than 30% this year, it might go much farther if the actual conditions on the ground are as awful as they seem to be. Given that home builders must borrow heavily to construct their projects and that their buyers must also borrow heavily to finance their purchases, the ITB industry is particularly vulnerable to interest rate shocks. This crash has been coming for a long time, as prices got further and further away from what they should have been. Very large drops have already begun their descent, and at this point, nothing can stop them. If you already own a house with a low mortgage rate and didn't buy it during the bubble, then don't worry. But if you're in the market for a home right now, you should think twice. Comparison in supply and demand. The number of houses being built in the United States is at a record high, with 1.7 million constructions now underway. In 2006, the number of homes in different stages of development peaked at around 1.4 million. In 2006, the U.S. population was growing by almost 3 million people per year, but now it is only growing by between 500,000 and 1 million people per year. With an estimated 2.5 persons per family, this would have necessitated the construction of over 1.2 million homes in 2006, but just 400,000 by 2022, assuming a 50,000 to 1 million person increase in population. With inflation-adjusted incomes falling and life expectancy falling because of the coronavirus and other things, there is reason to assume that population growth will be much slower in the future. Who is going to purchase all of these properties when interest rates on mortgages are above 7% and population growth has stalled? In the present housing market, a bubble formed over the course of 2 years due to an endemic boom. In contrast, the 2008 financial crisis was fueled by low interest rates and loose lending practices. After months of economic turmoil and lockdowns in 2020, tens of thousands of individuals started fleeing cities and states with higher housing and rental rates. As a result, certain markets saw overnight surges in demand. To make matters worse, supply chain problems meant that the number of new buildings being built throughout the country was consistently below the level of demand. The construction work after the endemic has now caught up, and the timing is terrible. July 2022 had a year-over-year decline in house sales of 20%. By the end of September, the number of new mortgage applications for a 30-year fixed rate hit its lowest level in 25 years. Currently, there is a 10.4-month supply of new homes in the United States. In fact, that's the highest it's been since 2009. The conclusion is that there are currently more houses being constructed than there are potential buyers. And this time, it might be builders, not banks, who are saddled with excess inventories. Since the developers are suddenly the ones in the red, all new buildings will come to a near standstill. Several spec builders, who scored big over the last 5 years, are now bogged down with excess inventory. Home prices are expected to fall by 5 to 15% in 2023, according to experts. This pattern, if it persists, might signal the beginning of a market transition from a seller's to a buyer's market. Mortgage demand is tanking same as 2008. America and the rest of the world experienced a cultural moment in the 2000s when buying real estate was held up as the only way to build wealth. After the market collapse of 2008, many would-be homeowners were disillusioned and thought it wasn't worth the effort to buy a house. Much of a similar mania prevailed from late 2019 through early 2022. Now, demand has really started to drop again. Since the epidemic, housing prices have risen dramatically, and mortgage rates have risen beyond 7%, making this perhaps the worst moment to purchase a home in our lifetimes. This is happening around 2 to 3 years before what might be another greatest time to purchase a home in our lives window. Annually, mortgage application volume is down 42%. That's unbelievable, especially considering that bidding wars were commonplace only a few months ago. But there's a well-known economics paper from 2007 called "Housing is the Business Cycle." The author contends that the Federal Reserve, in its efforts to control inflation and unemployment via interest rate setting, the Federal Reserve has unintentionally built a housing bubble and will be forced to trigger a housing crash. To prevent the housing market from derailing into speculative turmoil, it is argued that the Fed should begin raising interest rates earlier in the economic cycle. Does this sound familiar to you? The basic notion is the Fed will be less equipped to cushion the eventual collapse if they delay raising interest rates during the boom. The paper was written in the midst of the 2000s crash, when buyers and sellers were in a standoff similar to today's, with sellers refusing to sell and buyers unable or unwilling to buy. It made the interesting but incorrect prediction that prices would not crash, but transactions would grind to a halt. In the years that followed, prices dropped to levels not seen since the Great Depression. Here we are again in 2023, with leading indicators for future sales falling off a cliff. The main difference between 2007 and now is that the Fed was much more behind the curve this time. In contrast to 2007 and 2008, when the government made concerted efforts to stabilize the housing market, the Fed is likely unable or unwilling to put a floor under home prices because of the high cost of doing so. Due to the massive wealth transfer caused by the present housing bubble, it's possible that the sudden fall of the housing market is a feature, not a flaw, of Federal Reserve policy. The million-dollar question is, will this housing market crash outdo 2008? As of yet, one can't say for sure. Rising unemployment was a major factor in the housing market collapse of 2008. House prices might continue to fall steadily if unemployment rates remain low. But if the unemployment rate were to climb to 6%, 7% or more, millions of eager sellers would flood the market with relatively few takers, owing to the shifting demographic realities of America and the magnitude of demand that had already been dragged forward during the pandemic. To top it all off, in 2008, homes were really inexpensive, which attracted a lot of institutional investment. Even if housing prices dropped another 10%, 20% from here, values would still be more than they should be. Those declines would only take us back to 2021 prices, with rates dramatically higher. Because of these reasons, it's very possible for this crash in housing prices to exceed the 2008 crash in magnitude. That's all for today, guys. If you liked this video, be sure to leave a thumbs up, subscribe to the channel, and press the bell icon for any new updates. See you in the next one.